In 1999, Congress repealed a law that had held for 66 years. Wall Street celebrated. Most people have no idea what actually changed. The accepted story goes like this. Glass-Steagall, passed in 1933, separated commercial banking from investment banking. Banks couldn't gamble with deposits. Then in 1999, the Gramm-Leach-Bliley Act tore down that wall. Banks merged. Risk exploded. 2008 happened. Clean narrative. Except the actual money trail tells a different story, and here's the trick. The separation was already dead decades before Congress officially killed it. By the 1980s, investment banks had quietly started doing what Glass-Steagall said they couldn't. They created holding companies. They launched discount brokerages. They securitized mortgages. Regulators looked the other way. The law was still on the books, but enforcement had evaporated. Commercial banks watched competitors rake in trading profits and lobbied hard to compete on equal ground. Here's where the money actually went. Before repeal, a bank's deposit base was locked away from speculative trading, theoretically. After repeal, that same pool of customer deposits became available for proprietary trading desks, derivatives, mortgage-backed securities. One institution now held the risk. When housing prices stopped climbing in 2006, that risk didn't spread across separate entities. It concentrated. The real culprit wasn't the repeal itself, it was the timing. Repeal happened right as subprime lending exploded and credit derivatives became impossible to value. Glass-Steagall, if enforced in 1999, might have mattered. But deregulation met a ticking bomb. The economy was already leveraged to the hilt. So what actually changed in 1999? Legally, banks could now own investment operations without a firewall. Practically, they'd been doing it for years. What the repeal did was formalize a reality that was already baked in. It removed the last pretense of separation, and it removed the last tool regulators had to force it back. The implication, repealing Glass-Steagall didn't cause 2008. But it did eliminate a circuit breaker. It let the financial system consolidate risk into institutions too big to fail. And it happened at the exact moment when that risk was becoming lethal. The lesson isn't about one law. It's about the gap between what rules say and what markets actually do. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for deep dives into the hidden mechanics behind every financial story. The ones where the real answer is never what the headlines say. This video is for educational and informational purposes only and is not financial advice. Always do your own research.